This is where things get really interesting, because let's say this right here is a bank. So a bank is gonna lend you a home, and I'm gonna draw you a nice mustache, or as we like to say it in my native language Punjabi, a much, or for our female followers, I'm gonna draw you a nice braid, or as we like to call a braid in my native language Punjabi, a gut. You go out and you get a mortgage from the bank so you can go out and buy a home. Now, the bank is gonna get all these loans, and then they're gonna package up these loans, and then they're gonna sell it to somebody like Fannie Mae, FM. Now, Fannie Mae is an organization that buys up all these loans from the banks, they chop it up, and then they either keep it or they sell out some of these securities as mortgage-backed securities. But the interesting thing is Fannie Mae, the organization that is buying all these loans from the bank, has said that they predict a recession is coming in 2023. However, they also said that although we might see a recession, they're not too worried about it because our housing market is so strong, so it will cushion the blow of the recession. So this organization, the organization that's buying up all these loans from the bank, says that we are going to see a recession in 2023. However, it's not going to be that bad because the housing market is so strong. However, these banks that are making loans are seeing mortgage applications drop because interest rates are going up. And so to combat this higher cost of getting a mortgage, they're now selling these people ARMs, adjustable rate mortgages, because that is more attractive, especially in the short term, because you can get into a mortgage with a much lower teaser rate, and then after a few years your interest rate's going to adjust. Here's what that looks like. You want to go out and buy this $500,000 home, and now you have two options. You have the 30-year mortgage or the 5/1 ARM. So the 30-year mortgage at the time of me recording this video is something like 5.5%, which means that if you put down 20%, which is $100,000, you're going to be financing $400,000. If you finance $400,000 at 5.5%, your monthly payment is going to cost you something like $22.70 a month. And remember, in both of these cases, you're putting down $100,000, so the down payment doesn't change and the price of the home doesn't change. But then the bank says, well, another option, instead of you getting this 30-year fixed, is you can do the 5/1 ARM, and then we can give you a 3.7% interest rate. Now, they don't advertise it as a teaser rate, but that's what it is, because this 3.7% teaser rate isn't what you get for all 30 years. It's 3.7% only for the first 5 years, and then your interest rate's going to adjust. But then what the bank says is, look, you can buy this home and only have to pay 3.7% right now, which means instead of paying $2,300 a month, you can pay $1,840 a month for the exact same home. Now, this is going to look a lot more attractive, but then there's something that you have to look at right here. This 5/1 ARM. What that means is after 5 years of you paying $1,840 a month, your payments are going to readjust, and they're going to readjust to what the market is. So if interest rates don't change, well, then your interest rates are going to go up to something around $2,200 a month. But if interest rates continue to go up, which is what the Federal Reserve Bank says that they want to do, they keep saying that they want to raise interest rates to fight inflation. If the Fed stays true to their word, I'm saying if because you never know what the Fed is going to do, but if the Fed stays true to their word and they continue to raise interest rates, which is what they say, which is what the government says, which is what everybody is saying that the Fed is going to need to do to fight inflation, that means in 5 years, we're not going to have 5.5% 30-year mortgages. Maybe it'll be 7%, maybe 8%, maybe 10%. I don't know, right? We don't know exactly what the Fed wants to do. We know that the Fed wants to continually raise interest rates multiple times in 2022. There's been predictions that the Fed is going to raise interest rates 5 more times in 2022. We've only raised it twice so far. And so if the Fed continues to raise interest rates in 2022 and 2023, and then 5 years go by and mortgage rates are significantly higher than where they are today, well, then your mortgage payment is going to be a whole lot higher when it adjusts. Now, this is where everybody hopes that, well, I can just refinance at that point, and then I can just refinance and then lock in a 30-year mortgage. But let me also remind you that when you lock in the 30-year mortgage in 5 years, you're still going to have to pay a higher rate, because if interest rates continue to go up, your mortgage rate is also going to be higher. And then you're also banking on the fact that home prices will continue to go up, because what happens hypothetically if in 5 years home prices drop? If home prices drop and you don't have any equity in your home, or if you don't have a lot of equity in your home, well then you might not be able to refinance because banks are going to look at you and say, okay, you bought the home for $500,000, you have $100,000 worth of equity, but today your home's only worth $385,000. So if your home is only worth $385,000, now I know I'm ignoring the fact that over the next 5 years you're going to pay down some of the principal, but not a lot over the first 5 years. But banks are going to look at you and say, we don't want to refinance you because it's too risky of a loan. So now if you can't refinance, if you can't make the higher payments, either you're going to be forced to sell at a loss, or that's what pushes people into foreclosure. This is exactly what happened during the 2008 crash. Banks were advertising these super low teaser rates with adjustable rate mortgages because now you look at this, 3.7% is cheaper than 5.5%, but back then they never told you that your mortgage rate is going to readjust. Right now we're in an economic cycle where interest rates are going up. So if you're taking an ARM during a time where interest rates are going up, well, that means if things go as planned, when it comes time for your mortgage rate to readjust, you're going to have a higher payment. And if you cannot support that higher payment, either you're going to have to cut down your lifestyle, you're going to have to refinance if you're able to, or maybe you'll be forced to sell your home. The reason why adjustable rate mortgages are becoming so popular right now is because people are looking at home prices today. If that home is $500,000 today, they're saying, wow, I missed out on the opportunity to, one, buy this home at a discounted price because last year, home prices were significantly less. Between 2021 and 2022, home prices have gone up by around 20%, which means about a year ago, the same home with no modifications, no anything, was selling for $416,000. So with no extra modifications, no extra improvements, that same home from $416,000 is now selling for $500,000. And then on top of that, if you look at the mortgage rates, in 2021, you could get a 30-year fixed rate for 2.5%. Nowadays, it's around 5.5%, which means if you put 20% down, you would have only had to put down $83,000, almost messed up there, and in this case you got to put down $100,000, assuming that you're putting down 20% in both instances. And so now not only do you have to have a higher down payment, your monthly costs are so much higher because you're borrowing more dollars and you're buying the more dollars at a higher interest rate. Because 1 year ago you could have got the same 80% mortgage for about $13.10 a month. Now it's costing around $22.40 a month. So yes, your down payment is 20% higher, the cost of the home is 20% higher, but your monthly payments are significantly higher. I just checked my numbers and I made a little bit of a mistake. It's not $22.40 a month, it's $22.70 a month at the 5.5% mortgage. So what that means is not only do you have a 20% increase here on the purchase price, now your monthly costs are about 70% more. A 70% inflation on your monthly costs because your mortgage costs are higher and the amount of dollars that you have to borrow is higher also. So if you remember in the beginning of this video, I talked about how now your cost of home ownership is 10 times higher than the growth of our wages. Well, over the last year, between 2021 and 2022, let me actually put this on blue marker. Wages over the same course have gone up by under 5%. I'm going to be generous and say 5%, but it's been less than 5% on average across the country. So let's just say wages gone up by 5% across the country versus the cost of home ownership, your monthly cost is 70% higher. So your cost of home ownership is growing significantly faster than your wages, and unless your wages are going to grow by 70% between now and I guess now, well, the cost of homeownership is growing significantly faster than wages. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for a daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.